Are tariffs working, and what does that mean for your treasuries? Hello everyone and welcome to Markets with Markus. And thanks to everyone for their feedback, especially to Jeffrey for his long email that he sent us late at night yesterday. Much appreciated. So, this week it seems we finally left summer behind and went back to school, so to speak. Now it hasn't always been an easy week overall with the terrible things that have been happening. But let's focus on finance. So in the financial world, our homework, so to speak, was to digest all the data that come in this week. And there were a lot of releases, as you may remember from our channel here. We had the S&P adjustments to the index, we had inflation data, we had employment data. And the picture that emerged was that of an economy where employment is getting softer, while inflation is maybe a bit more persistent than we would have hoped. Overall, though, the market still pencils in a rate cut by the Fed when they meet next week for the FOMC meeting. So there's one more topic that we get asked a lot, and that's what's happening with tariffs. So with that in mind, we'll deal with we'll address three questions today. 1. Are tariffs working, and how well? 2. Will tariffs go away again? And 3. What does that mean for your treasuries, and what are we doing? So, are tariffs working, and how well? So yesterday, the Treasury released their monthly statement. So the Treasury every month puts out their P&L, so to speak, how much the government takes in and how much they spend. And part of that report is what they call customs duties intake, so essentially tariffs that the federal government collects. And the first impression when you look at those numbers is, yes, tariffs work. The tariff income has more than quadrupled since the new tariffs were first implemented in early April. So when you look at this chart, for those of you who can see it, tariffs until February, March of this year were always running around 7 billion per month, and that's been pretty stable. It was also around that range a year ago, August of last year. And then, as expected, Trump's new tariffs started to ratchet up the tariffs and the customs duties intake, as they call it. April, May, saw two big jumps that I said always took slowly effect. We had another sizable jump in June. Then it got a bit flatter, but it's still a little bit more every month so far from what we can see. And in August, so the latest numbers that were just released, it was 29.5 billion in tariffs collected for the month, which would make for, just assume it's the same now going forward, it's stable, let's say 360-ish billion per year. Now, 360 billion in tariff intake and tariff revenues is nothing to be sneered at. That is a decent amount of money. And now, like thinking with my head as a treasury investor, I'd rather have the money than not have it. But to put it in bigger context, it's also probably not a game changer. Just for comparison, the federal deficit, so the amount the federal government spends over what it takes in, will roughly be around 1.8 trillion at the end of the fiscal year. So if you put that more or less in a relationship, this 360-ish billion in tariff intake are roughly 20%-ish of that expected deficit. So having the tariffs clearly helps. Not having the tariffs, income would hurt, but we're talking a 20% difference in the deficit. It's not a game changer. It wouldn't make the deficit go away. Let's now look at the flip side of tariffs, the potential impact on inflation. So when the tariffs were first implemented, it was maybe not unreasonable to expect that they would push inflation higher, because clearly someone needs to pay the tariffs. Expectation is importers, producers would try to collect those from consumers by making goods more expensive. Now, to some people's surprise, we don't really see that much in the latest CPI numbers, in the latest inflation numbers. The inflation is still mainly driven by services. Services inflation is still higher than goods inflation, and by shelter, by housing. And goods also show inflation. So overall, they're also trending up. But some of the categories where you might have expected to see inflation actually show the opposite. So smartphones, non-prescription drugs are actually cheaper than they were a year ago. And even new cars are flattish to slightly down. So this shows probably two things. First, price setting for consumers is dependent on a lot of factors. Technological progress, increased productivity, protection of market share, especially for things like smartphones and cars. And second, most importers and most retailers usually, depending on the product, not always, but usually have a comfortable cushion, the profit margin, the retail margin, and the difference between what they pay the importer and what they charge their customers may in many cases just have been large enough to absorb those extra tariffs. So in other ways, the importers and or producers may have been just eating up the tariffs for now. Now, this may change again. We see in the latest numbers that goods and services inflation are converging. Goods inflation is coming up, services inflation is coming down a bit. So maybe we'll still see the inflationary effects of the tariffs with a bit of a delay. But again, so far, we haven't really seen it yet. Let's move on to the next question now. Will tariffs go away again? Now, I don't think they will go away again. And let me tell you why. So the lower courts, two lower courts actually, have already said that they think that the tariffs are invalid. And the legal argument is that the basis on which those tariffs were enacted was not sufficient to implement such sweeping tariffs. So when President Trump announced the tariffs, he based a lot of them, not all of them, but probably a very good part, most of them, on the IEEPA, the International Emergency Economic Powers Act, mouthful. So this act has not been used before by other presidents to implement tariffs. It has been used before for sanctions and things like that, so it's known, but not really for sweeping tariffs. So that's why the courts didn't like it. So not surprisingly, the administration is appealing. The Supreme Court has taken the case. And while this legal escalation, these legal appeals are in process, the tariffs will stay in place, at least until the Supreme Court decides. Now, when the Supreme Court will decide, maybe as soon as the end of this year, the decision could go either way. They could uphold it. They could also invalidate the tariffs based on the fact that the clause in the IEEPA that President Trump used may not be robust enough to support sweeping tariffs. But let's not forget, the lower courts did not say that the tariffs per se were illegal. They just said it was based on the wrong law, the wrong authorization to the president. So President Trump and his administration, even if the tariffs were not upheld by the Supreme Court, could turn around on a dime and reenact the exactly same tariffs again, either by passing a new law, which would probably, legally speaking, the most robust way, because then it's the Congress who does that, or maybe by even using another clause in another existing law that allows the administration to impose tariffs without going to Congress. Now that may be a bit more cumbersome, may have more formalities than the IEEPA, but I think many observers wouldn't be surprised that if that was happening. We'll see. Another discussion out there, we'll touch briefly on it, is if the Supreme Court was to invalidate the tariffs, would the US government have to give refunds? I think even Scott Bessent has been alluded to that, that might happen. The answer might be yes. If it was invalid, maybe the tariffs have to be reimbursed. But if we look at the numbers from before, currently it's running about 30 billion a month in tariffs. Not all of them will be invalidated. Some of them have been in place before based on other laws, other clauses. So let's say maybe it's 2/3, 20 billion a month. So for every month that those tariffs have been collected, and if they get invalidated, the government might have to refund $20 billion. No, that's clearly a lot of money. But if we put it into perspective, even at a run rate of 30 billion, that's like 1% of GDP per year. And the Treasury is used to worse or higher numbers of new debt. For example, next week the Treasury will be issuing, I think it's 240 billion of new T-bills. So even a refund of, let's say, for half a year, 120 billion would be painful, but would not be impossible. So overall, I think that leads me to conclude that tariffs will not go away, that the administration will probably try to reimpose the same or substantially the same tariffs, even if the Supreme Court doesn't uphold them for now. And it's also a bit of a reminder that we probably have a bit of a debt problem in this country. What does this mean for your treasuries and what are we doing? So as we just discussed, tariffs have a bit of a dual edge for treasury holders. On the one hand, treasury investors like the extra income. As I said, 30 billion in extra income for the federal government, nothing to sneer at. If, on the other hand, tariffs were to push up inflation, that would hurt treasury holders. Because if you have a treasury with a fixed coupon, inflation goes up, your real return goes down. So far, treasury holders with respect to tariffs have been living in the best of both worlds. The extra income is coming in, not fixing the debt problem, but mitigating, reducing the deficit. Whereas inflation is a bit higher, a bit more persistent than we would have hoped, but definitely not as bad as it could have been. So the best of both worlds. Now, before that background, we haven't really changed our investment strategy. We still hold medium and long-term treasuries. We still roll over short-term T-bills in our accounts and continue with what we've been doing. We don't have a strong conviction at this point that we need to change our investment strategy. But in light of the tariff discussion, but also of the impending Fed decision on rates, we definitely keep an eye out again for inflation. Inflation, as we've been saying, is the biggest enemy of bond investors. If you want to protect yourself against it, it's like insurance. You need to buy that protection, so to speak, before it happens, or the insurance provider will not take you, so to speak. So now is the time when we start thinking about that. And to close with that, I would invite you to join our member live this weekend, where we will be discussing inflation protection. What can you do when you're afraid of inflation, both as a bond investor and beyond bonds? And we'll also get very concrete and talk about the upcoming auction of the 10-year tips that is happening next week. Thanks for joining and hope to see you soon again.